Stronghold Wealth Management. If anybody's visiting us from the Florida state, that's our brand down there. I would like to thank all of you for joining us today. Just real quickly, Harvard Advisors and Stronghold Wealth Management, just to give you an idea of what we do, we're a financial planning and wealth management firm. And as part of our comprehensive financial planning process, part of what we do is determine what a client's needs are, and around that we build a portfolio for them. When we build that portfolio, we look for certain pieces to fill certain objectives, and sometimes we do that. We use what we refer to as private money managers, and Tom Johnson Investment Management in Oklahoma City is one of those that does a very good job and often fills that role for us. So we have asked them to do a little talk about interest rates, which pops up in the media every now and then, to discuss that a little bit. So with us today, we've got Doug Hawes and Corey Robinson from Tom Johnson Investment Management, and I'm going to let Doug take it away. So thanks again for joining us.
Well, great. Well, Keith, thank you very much, and thank you to those of you that have called in and joined us for this call today. And what I'd like to see is make this a conversation. And so if you've got any questions, I haven't muted anyone. If you've got any questions, simply just let us know. Say, hey, stop for a second. I had a question about that. Corey and I would much rather go through that and answer any questions you might have rather than leave one unanswered. So as Keith mentioned, we work with Keith as the money manager and as the portfolio managers for different portions of the assets of his clients. And he uses both on the fixed income side and on the balance side. And today it's myself and one of my colleagues also on the portfolio management team, Corey Robinson. And so what we'd like to do today is, again, just have a conversation. And I'm hoping that spend a quick 30 seconds or so just letting you know who we are, reiterating kind of what Keith said, and talk a little about our team. And then just talk about the interest rate environment, where we're at today. One of the things Keith and I and Corey had talked about was I think we get questions a lot of times, and you even see headlines of, are we looking at a bond bubble? And what exactly do we mean by a bond bubble, and should we be scared of bonds, and which bonds should we be scared of? And then take that into context of, I think, where we see a lot of other headlines are Fed tightening. We have been in certainly a very accommodative phase of the Fed monetary policy, and I think everyone's question is, when does the Fed raise rates and what happens there? And then look at it from the standpoint of our bonds and bonds generally in your portfolios, is where it is as an equity hedge and what that means for an overall portfolio allocation. So without any objections, I'll move on through that. And I hope what you get out of this today, if you're thinking of our firm anyway, think about the team that we're going to present to you here today and just our overall outlook of what we do. We're a separate account manager. So what that means is we're actually owning individual bonds, individual stocks for your portfolios in an account that you actually own. There's no fund, no commingled portfolios. It's your own account that you put into us through Keith's firm, and we act just as the money manager. And I think, again, I was going to spend very few seconds on this just to say, as Keith mentioned, we're in Oklahoma City. We're a separate account manager that's been in business since 1983. So we're on 32 years of separate account management. Our business is split about half equities or stocks and about half fixed income. And so I think Keith has used this more on the fixed and balance side, but we also are an equity-only manager. And I think one of the key things to get across is just that as you talk with myself and Corey, there's 4 other team members that do the same function here at Tom Johnson, and everything we manage as a team. So whether it's the stock side or the bond side, it's the same team of 6 portfolio managers. We're all chartered financial analysts, and I think we have an average of about 24 years investment experience on the team, and overall, I think we're slightly over 130 years of investment experience amongst that team. So moving forward, we kind of always like to start things off a little bit of humor, and I hope if you're seeing this on your screen, let me ask that. Hopefully everybody does see this on your screen, and your screen's coming through so you can see this presentation. If not, speak up. We'll make sure we can fix that for you. But what you see here is just 2 different scenarios, and one is some people sitting here, as you can see, taking glasses of wine and saying they thought they felt it or tasted a hint of what the Fed might do. And that's really what we see every day. We see someone parsing some statement saying, well, the Fed's going to raise rates in September. No, wait, it's going to be June. Oh, wait, we were wrong. It might be September again. And then you also, there's a person here talking about a riddle he heard, and it's, whether or not which falls faster, a pound of bricks or a pound of paper. And the response is, well, is that 30-year paper? Well, 30-year paper meaning 30-year bonds and long-term bonds. And in an interest rate environment that seems to be moving up at times, those 30-year paper certainly has more volatility. So that's kind of where that comes from, and I think they're appropriate for some of the outlook and some of the topics for today. The next slide here is just simply a quick snapshot, and I'm not going to spend time on this just so we're all operating on the same page and under the same assumptions as to where things are today. And what you see is that right now the Fed fund target is 25 basis points. And the next step, people seem to think, is they're going to move that up at some point, probably move up 25 basis points. So at some point we might see a Fed funds target of 50 basis points. On average, right now, national average of a one-year CD rate is, I just checked today, it's actually 27 basis points rather than 21. You can probably find a lot better than that at different local banks and such as they're making promotions for those. But at the same time, that's the national rate. 10-year Treasury, as of the 4th of August, it was 2.1%. Right now, it's about 2.3%, and the 30-year Treasury about 2.9%. Put that into perspective is where we are on the economy. Inflation, essentially no inflation on a CPI basis at 1.8%. Unemployment has certainly improved from an unemployment number down to 5.3, and an economic growth or GDP of 2.3%. Now, I think an interesting topic or a couple little data points here is just to look at in the middle of the page there, crude oil and gasoline. And crude oil is getting beat up again today. And those of you joining us from our home state of Oklahoma, you probably are particularly aware of that. It's been certainly a painful area, but I think just to look at where it was a year ago, 44 and change now, was 93 at this time last year. What that, I guess, means for good news for those of us out there that have to fill up our cars is that the national retail gas side has come down quite a bit too. So that's just kind of put in perspective where we're at. So as we go through this, and we're going to talk about rate environments and Fed tightening and what all this means, I think we have to really put in perspective that, at least from Corey and I's take on this, we're dealing with, the markets, I should say, are dealing with what I would consider unprecedented central bank intervention. By central banks, I mean the Fed, European central banks. This also has Bank of Japan on it. But it's a kind of an ugly chart with a lot of numbers. But all it really says is that we've seen since 2008, when we started talking about stimuluses and trying to get us out of the credit debacle, we've seen more and more money thrown at the issue, more and more liquidity provided, and just larger balance sheets of those central banks. So as of now, we feel there's kind of a synthetic input into the market as to rates being pressured down. Now, that's all been well and good for the economic expansion. It's kept it moving along at a tepid pace. It's been very good for stock market returns since the debacle of 2008/2009. We're 7 years past that, and I think we've seen good stock market returns on average through there. But what does it mean if you're a person out there that's invested in fixed income investments and needs income for your portfolio? Well, I think this is a neat little kind of factoid chart that I use a couple of times with advisors and clients seem to like. But if you had the opportunity to retire in 2007, and you had a very nice retirement nest egg of $2.3 million, and I'll tell you I use that number because it comes out to around $100,000 income in 2007. If you had put that money in short-term Treasury bills, not a good investment strategy, but a risk-free rate, 3-month T-bills, you could have earned $100,000 in income off that $2.3 million portfolio. If you did that today, you earn $3,000. Now, I always look at this and say, we all have to take an opportunity to cut expenses and tighten the belt where we can, but living on $3,000 in income versus $100,000 in income from the same size portfolio is not a belt tightening or an expense cutting. That's a definite lifestyle change and a definite allocation change. And so it's been good for some economies and some stock markets, but it's not been good for the savers and investors out there. And then I put to you, we always hear about how low rates are. Are they too low or are they too high in this environment? And I think they're probably synthetically pushed lower. But if you look at us versus our trading partners out there, there's a couple interesting things on this table, I believe. First, we hear all the headlines. We expect the rates in Greece to be high. I'm sorry, I should back up. This is 10-year government bond spreads or 10-year government rates across different countries. And what you see here is, of course, Greece is the highest, almost 12% 10-year. I understand that. I'm not really willing to loan Greece money for 10 years right now. I don't think that'd be a great investment. But I look through these, and some of these are kind of perplexing to me or make me think, well, maybe the rates in the U.S. aren't that low, because Portugal is just slightly above. As of the date I did this on the 4th, the U.S. Treasury rate was 2.17% on the 10-year, and now it's about 2.3 and change. But it's just slightly below Portugal, and it's actually above Spain and Italy, Ireland, Belgium, some of the others. Now, I would argue that despite the fact that I won't defend the balance sheet of our Fed, I think we have our own problems sometimes when you look at balance sheets. I would argue that I think the U.S. is a much safer place to loan money to than Italy or Spain based on their debt and what their economies look like. So just put it in perspective, maybe the Fed doesn't have any big pressure to move rates from that global perspective. And then another thing that I think the Fed is always looking at is inflation. I'm going to talk out of both sides of my mouth here on inflation. One is we don't see core inflation. We don't see headline inflation. And I think I showed the number of 1.8%, which is kind of a benign number. And that's one of the things the Fed's looking at. I think for you and me that are individuals and we're out there purchasing things or buying things, purchasing services, I think one of the kind of splits we're seeing here, and this was just a chart on the Wall Street Journal a couple weeks ago that I found interesting, but when you look at goods you're purchasing, television sets, a bottle of wine, stationery, sports equipment, those things actually over the last 5 years you've seen come down in price. Yet if you look at the services related to those things, for instance on television sets, I think is the most glaring example, average TV set, over the last 5 years is down about 57% for the same type of TV. However, you're paying almost 14% more for that cable or satellite service to have any use of that TV. Same thing, you look at household products, a little bit of increase there, essentially flat over the last 5 years, yet you're spending about 7.8% more for household domestic services. So this comes back to a service economy and the growth being on the service side relative to the manufacturing side. The next chart here is something that I think the Fed has been taking a look at. They've talked a lot about as unemployment got below 6%, they'd be in a position where they probably needed to raise rates. Well, once they got there, they kind of started backpedaling and saying, well, we're looking at other aspects. And one of the things we're looking at is that, they were looking at the cost of wages. And up until just the most recent reports, you started to see that wage pressure moving up a little bit, the total civilian employment. You can see that on the right-hand side of the chart here. It starts to increase. It's still not great, but 2.5% type growth or expense growth. Then all of a sudden, it just trails off right there towards the end of the last reports. And I don't know exactly what to say that comes from and attribute that to, but I think it may very well be what gave the Fed the opportunity to back off of the headlines of we're going to move in June, we're going to move in September, we may not move at all in the year. And it might come from the fact that we've seen some job layoffs in the energy sector. Those are traditionally higher paying jobs, therefore they would influence the overall cost of wages a greater bit than the average job. So that's just kind of my thoughts on that, but I think that might be something the Fed's looking at and gives us an opportunity to maybe not have to raise rates. And then, so then when it brings us to, well, if rates are so low, do we need to worry about this bond bubble? And over the last 50 years, we can look at it and say, yes, we're at near 50-year lows. So I would say that the, appropriate reaction or the appropriate consensus opinion going forward is, yes, rates probably will move up. They certainly probably have an opportunity to move up more than they move down, just from where we're at. So do we need to be concerned about a bond bubble because of low rates, and what's going to happen to those bond portfolios? And I think it really comes down to, it depends on where you invest for income as to whether you need to be concerned about this bond bubble. If you look at this chart, what you see is there's 5 lines on here from blue to purple. And blue is a U.S. Treasury yield curve, and purple is a double B corporate bond yield curve. And all this means is, where you go from blue to purple, we go down in quality, and from the left-hand side of the chart to the right-hand side of the chart, we go up in maturities. So I've always asked, and you're welcome to speak up if you want, but if you're thinking about bonds and you're thinking about conservative income, what is kind of a reasonable idea of what those bonds should yield? What do you expect from your bond portfolio from a yield perspective? And without any responses, I usually hear, I will tell you, 4.5%, 5%. And I think that's a reasonable assumption is what you want off your bond portfolio and not taking too much risk. But in this environment, to get that, you've got to be out there very long, 20 plus year maturities, or you've got to be in up towards the purple. So I say you'd have to go long or ugly. So what does that mean, and should you be concerned? Well, if you go long, this next chart, right-hand side of the page, that's a 30-year Treasury. And based on duration, which is simply a measure of how your bonds move in a given interest rate movement, if rates were to move up 1%, that 30-year Treasury is down 17.5%. Now, conversely, if you're invested over here kind of in the intermediate structure where we invest bonds and your portfolios would be invested 3 to 5 years in duration, 3 to 5 years, you see still your bonds would be down and interest rate move up, but in a 3 to 4.5%, 3 to 5% type move. So certainly there's a lot of difference between a down 17 and a down 3 or 5. The other side of the equation comes into that quality. And we invest in just A-rated or better bonds, and I'm not pushing this as to say, hey, invest with us, but I'm just saying make sure you understand when you're looking at that chart I showed about where you're getting income from. If you're out there on those purple lines further up to find that income, you're in a AA or a single B bond, the differences in default rates, and this is the cumulative default rate since 1920. So over a 10-year period, what were the percentage default rates in the different qualities of bonds? A-rated bonds, 1 in 31 bonds essentially had a default over from that time frame. You get down to just 2 steps down into a BA or single B, and it becomes 1 in 5 or 1 in 3. And what I always say to clients is that as those move up, you've probably taken out there to get income in what you believe are conservative fixed income type investments, and you've probably actually taken on at least as much volatility as you would in a high quality equity portfolio. So just, it's kind of that, be aware of what you're investing in, and to get to those type of returns, you're probably taking some sort of risk. And then I'm going to turn this over and let Corey talk a little about, why to be allocated to these intermediate bonds and what they do for you.
Yeah, so with low rates, I guess most people's question is, well, why should I invest in bonds at all at this point? And from our perspective, there's really 4 reasons. Income, at this point with low rates, income's fairly low. The current yield's between 1.5% and 2.25%. But you can see the average yield to maturity historically versus the returns. The returns can be higher than the yield. But again, with low rates, bond returns are going to be muted over the next few years. I'd estimate somewhere between 1% and 4% over the next 5 years is probably a reasonable range of returns for high quality intermediate fixed income. And the third reason is diversification. Intermediate bonds have a very low correlation to equities at 0.18, so there's quite a bit of benefit to adding bonds to an equity portfolio. They have a negative correlation to equities in down markets and protection. As you can see here, since 1926, there have been 7 equity markets where there was greater than a 20% decline. And in all 7 of those instances, intermediate bonds had a positive total return. So they do provide, like I said, diversification benefits and protection in down markets. Then I guess next question is generally, okay, well, what about when bonds do poorly? How do intermediate bonds fare? And here is a table of kind of some bad markets throughout history. You'll see there's, I don't even know how many there are, 9 down markets there. On average, a 10-year Treasury is down almost 10%. Long-term bonds are down over 11%, whereas intermediate bonds are down less than 1.5%. And in fact, if you look at the individual periods here, intermediate bonds were actually positive in 3 of those ugly bond markets. Now, the question is kind of, what's the Fed going to do? I think the market seems to believe that the Fed is getting closer and closer to raising interest rates. Right now, the futures market implies that there's a 75 to 90% chance that the Fed's going to raise rates by the first quarter of next year. So what happens when the Fed increases the Fed funds rate? This is a chart of the yield curve, which is just a line chart of each maturity of Treasury bonds. And it's the yield curve at the beginning of the Fed tightening cycle when they started raising rates and at the end. The blue is the beginning and the red is the end. You can see in every instance, interest rates go up when the Fed tightens. And the yield curve tends to flatten. Short rates go up more. So what happens performance-wise? You see in 4 of the 5 instances, you still do, even though rates go up more at the short end, shorter bonds do better because they have a shorter duration, less interest rate sensitivity. Now, the last cycle, 2004 to 2006, is a little bit of an exception because the 30-year was actually the best performing, but on average, shorter bonds do better in Fed tightening cycles. Yeah, then if the past is any indication, here is the current yield curve adjusted by the average move in rates, and then you see the total return by maturity. Shorter does better. And then here are returns of the S&P. and the long and intermediate bond index. You can see the intermediate tends to outperform, and surprisingly, equities have been positive in every Fed tightening cycle. So how did the Fed tightening cycles play out? There have been 5 of them since 1982. Kind of the average cycle lasts just over 1.5 years at 1.65 years. The average interest rate hike is 3.2% from beginning to end, and that Fed rate hike doesn't go out through the rest of the yield curve equally. You know, the Fed has a much larger impact on shorter rates than they do longer rates. You can see that the 1-year Treasury is up 2.76%, almost as much as their rate hikes, but the 10-year is only up 1.42%, which is less than half of the rate hikes. So as I pointed out, you know, shorter rates go up more, which causes the yield curve to flatten. One surprising thing to me, at least, was intermediate bonds were positive in each of the past 5 Fed tightening cycles. But there is one big caveat to that, is interest rates were considerably higher at the beginning of past cycles than they are now. You know, they were just over 6% versus 1.7% currently. So chances are, over a Fed cycle, we might see some losses in bonds. Another thing is intermediate bonds outperformed longer-term bonds in 4 out of the 5 cycles. So intermediate kind of tends to be the place to be. And again, I pointed out equity returns were positive across all 5 cycles, which I thought was interesting.
And then I think, again, one of the things Corey pointed out right there was that we hear all the headlines of, oh my gosh, the Fed's going to raise rates and it's just going to be ugly. But you saw there that on average, the equity markets did pretty well. And I think a lot of that has to do with that the Fed's usually tightening during what should be growing economic times or expanding economies. Keith had asked me a couple of questions about, and I've dealt with this with clients as well, that you're looking at and they're asking about, well, why be invested in bonds at all? Or if I'm worried about this market correction, why don't I just go to the sidelines and wait? And so I looked at this and I thought, you know, that's not a bad suggestion. I mean, if you, over the last 15 years, if you look at 15 years of data, if you time it correctly, and you invest $250,000 in, like we chose here, 2,000 for the 15-year period. If you invest $250,000 and you're able to miss the 15 worst days, so the worst day each year in 15 years consecutively, your investment grows to $642,000. Whereas if you just left it in at the entire time, it only grew to $351,000. So yes, you can do a whole lot better. However, if you look at the converse of that, and you said, well, now wait a second. What if I missed the best 15 days? So in the first scenario, I was smart enough to avoid the 15 worst day each year for 15 years. And in this scenario, instead, I'm investing all but the 15 best days. Well, that investment then becomes the same as what we'd expect from the last chart. Over the time, it's $351,000 if you're invested throughout that 15 years. If you miss the best 15 days, 1 day each year, the best day each year, that investment, you've actually lost money, and that investment's only $190,000. Well, when I look at those numbers together, first I think, you know what, the upside kind of trumps the downside. I lose some money, but I've got the opportunity to make more than $300,000. And then I have to look at it and say, well, are you that good? Can you pick those numbers? And so when I did that, I looked, and Corey and I looked through this, and in order to do this right here and pick the best returns for 15 years except for the 15 worst days, you've got to pick the worst day each year and not be invested for 15 years in a row. Okay, your odds of winning the Powerball lottery are 1 in 175 million. And the biggest number I could think of was the U.S. debt, which is about $18.6 trillion. If you do the math on correctly avoiding only the worst day each year 15 times in a row, there's about 251 trading days in a year. That works out to be 1 in 988, and you can see the numbers go on. And I had to look this up. But that's 1 in 988 decillions. I didn't know that number existed, but it's a decillion. So I would say to you that you're probably not going to be able to do this miss just the 15 best days, and it looks like you're better off if you can keep invested throughout the time. And that's something that we always say, stay invested, time in the market, not timing up the market. And so on that note, I think it's good to think about what another quality of high-quality intermediate bonds, or another aspect, is that they tend to be a good hedge for equities, and they allow you to stay invested. So in other words, if you're just sitting in a 100% pure equity portfolio, or really 100% of any asset class, you've got the opportunity that you're going to have bad times, you're going to want to be out, in a balanced portfolio where you add these intermediate bonds to it, it decreases that volatility. And so what you do is just adding bonds captures the majority of diversification benefits versus diversifying across other asset classes. You're gaining the diversification of just owning, as Corey pointed out in his first slides about bonds. They're very much a low correlation, and in fact negative correlation in down markets. A 60-40 mix is one of the things we look at, and that's kind of a core balanced portfolio. It actually provides the best risk reward over a 20-year horizon of all equity to fixed allocation. So if you tinker with that allocation, it always seems to come back to, well, that's just, everybody just throws that as a default of 60-40. Well, it actually is a really good default, and it works out to be a good overall asset allocation. And then the other thing is that based on that, a 60-40 mix of high-quality U.S. stocks and 40% high-quality intermediate bonds never had a 10-year losing period going clear back to 1881. And then also we can look at and see that you've reduced the severity and duration of your portfolio declines, and on a rolling 10-year basis, it gives you about 82% of the return of an equity portfolio and only about 69% of the risk. Well, let's look at that one other way I think that's important is, in this day and age, you hear a lot about diversifying across a whole bunch of different asset classes, and I think that's correct. You can optimize your portfolio returns by using different strategic asset classes. Some say 6, some say 9, and that is true. You can't have the most optimal return for the best unit of risk. But if you look at this chart, and in that yellow box there, what you find that is, if you just go to a simple 60-40 stock bond portfolio, you end up with about 95% of the returns for the same amount of risk you're taking, and you get about 70-90% of the diversification of going through that asset allocation of 7 different asset classes. And so, yes, you can correctly optimize your portfolio and do better, but the difference is for 5% returns. That's not 5% versus 10% return over time. That's, in this case, it's 8.58% versus about 8.23. So think of it, it's a 5% difference in that annualized return. And I just thought that's an interesting way to look at one other aspect of bonds and how they can really help a portfolio and not just from an income perspective. I hope what you got out of this today, we kind of try to go through this quickly and make sure we gave you some information that will be helpful on the bond and interest rate side and give you some of our thoughts as how we look at things. But I hope what you came out of this today is that high-quality intermediate bonds are less volatile than long bonds, and they actually provide less downside risk in any rising rate environment, which we would expect that because of duration. When you look at it over time, you actually find that it's done well in the different cycles. And even in ugly bond markets, there's really limited downside in intermediate bonds. And I think one of the key takeaways here, and I commend Corey, a lot of that, the majority of that Fed work is stuff we've been working on here internally, and Corey had done crunching the data on. And what you find out is that the headlines out there say that as soon as the Fed starts raising rates, beware, it's going to get ugly. And really, it's not a market killer. Yes, it's probably, I would say that you're probably going to see a downdraft in the equity markets. There's going to be a short-term headline problem with, yes, the Fed finally raised rates and people are going to run for the exits for a little bit, but on average, the S&P still had really good returns, and that's probably because, as I said, the underlying fundamentals should be strengthening if the Fed's in a mode of tightening. And then finally, we think the bonds continue to be, simple 60-40 mix, and bonds are an excellent diversifier for your stocks, and that if you can get to just bonds and stocks in the right mix, you get your majority of your diversification benefits, and you're able to keep a portfolio invested in the market so that over time you've actually added and created wealth. So do we have any questions, or is there anything else they'd like to talk about? That was where we wanted to leave with today, and hopefully it was useful information for you.
I have a comment, or I guess you'd call it that. It seems to me like that this is not a good time to be in stocks or bonds, given the fact that you really don't know when the rates are going up, and they're so extraordinarily low at this time. And then the stock market seems to have no impetus as far as going forward. I think they've lost some of their luster. If you look at the earnings reports that have come out, boy, the energy thing really got hammered.
Yeah, energy.
So I don't know, I understand what you're saying, I agree with it, but it doesn't look like it's really a favorable time to be doing too much of anything.
Well, I would agree with part of those comments. Firstly, yes, I think on the energy sector has been absolutely unduly punished. I think if you look at across the board, the more marginal energy companies are suffering a lot more. Of course, the stalwarts, and the high-quality companies have been beat up as well, but I think that's a place where you want to stay if you're going to stay on the energy side. As far as bonds and stocks, I think you're right on the point of what we said about bonds. It looks unattractive from an income perspective, but on the high-quality intermediate bond side, if we think there's correction in the equity side, that's where you want to be because of the diversification benefits, and actually in past corrections, intermediate bonds have done pretty well. It seems to be that as equity markets get ugly, people run for what is the highest quality, which turns into be intermediate bonds. Now, on the stock side, and are we at a place where we're going to see a correction in the market? I never want to say no, but at the same time, I know that I don't invest for a correction in the sense that if I look at just overall, and I didn't put any data in here on price earnings multiples and such, so I just look at overall price earnings or the cost of, I talk in PE multiples all the time, but the cost of what you're paying for each dollar of earnings that a company earns. You're correct. The most recent earnings reports are not great. However, if you pull out the energy sector, when I looked at it a few days ago, the S&P, there had been about 85% of the companies had reported, and what you saw was that just on average across those 85% of the index that reported. Right now, including energy, we had about a 1.5% growth rate on the sales and about a negative 1.4% earnings growth rate. In other words, earnings declined about 1.4%. If you pulled the energy out of that, just because they were down so much, what you actually saw was again, not excellent, but a relatively stable, about where we've been in the last couple of quarters. I think it worked out to be about 4% earnings growth on the index. So when we couple that with a 2.5% GDP, which is kind of the number we're looking at, what I would call tepid growth, but not a recession. We do that with very low interest rates. What we found on the stock side, and again, remember our business is half stocks, half bonds, we found on the stock side is that this is probably a time where it's not going to be, hey, I need to buy this particular index, or hey, I need to buy this particular group of stocks. It really is a bottom-up, meaning fundamental analysis and security selection. And what we found in our portfolio is the value added has been when we can go through and look at some names that they're not trading, at the higher multiples, and we can find some, maybe they've had some short-term problems, and we can find the opportunities where we're not investing for the next 30 or 60 days, but rather the next 3 to 5 years. So I can't say that no, there's not going to be some sort of correction, but I can tell you that I know that I'm not smart enough to call exactly when that's going to be. And so if I can allocate to a group of high-quality equity investments with better than market-type valuations and high-quality intermediate fixed income, I think over time that's a winning strategy. And I can't foresee on the stock side, I can certainly see corrections. We've seen those in the past. On the bond side, I just don't see a scenario where high-quality intermediate structured bonds are going to be something that are going to really hurt your overall portfolio. Now, they could go down, but I just don't see, as we saw in those numbers, they just don't go down a lot, and you're still picking up some income. And here's the flip side of that. As rates move up, which becomes ugly for bonds, in an intermediate portfolio that's structured across a shorter-term ladder or has some liquidity in the portfolio, you're reinvesting at higher rates. So one of the things we do is stress this portfolio and look out across different interest rate scenarios. And on an intermediate structured portfolio, for our portfolio, 3 and 5 years out, the returns and the client's actual income are much better if we get a rising interest rate environment. There'll be some short-term minimal pain along the way, but you're better off 3 and 5 years out from an annual growth or compound annual growth rate and an overall portfolio value, as well as your income nearly triples in a large interest rate move. Sorry, I rambled on there, but did that answer your question, Bart?
Well, yes and no. All the things you say are, probably accurate, but I guess all I was referring to is there's not any compelling reason to do anything differently. I didn't mean that you shouldn't be invested. I just said, and there's no compelling reason to make much change in the equity or the bond side of it from what you're saying.
No, I think it really comes down to your time horizon and your investment objectives as to where you need to be on the allocation side. Now, as far as what short-term tactical moves to make, I would tell you that we're not. I mean, we sold a little bit of energy exposure. I'm not avoiding energy. I'm trying to again own the best quality I can. On the bond side, we're sticking with we're not chasing income. What I would caution people to is it's definitely not a time to chase income and chase yields on the fixed income side. If you're going to look for income and you're going to look for, you might even look at some high dividend paying stocks that you have some comfort level with. because there's actually an opportunity there more so than there is on the bond side. Realize you're taking on equity volatility, and it's definitely not a substitute for high-quality fixed income, but it could provide income. I wouldn't chase income right here. I mean, I think the yield, as I've mentioned on that yield chart, that's the part that scares me the most about individual investors is if we're looking for income, are we looking in the right places? Any other comments or questions? Keith, did you have any?
All right, no, I'm good. Actually, that was excellent, guys. I appreciate it. Just so everybody's aware, I know we covered a lot, or I shouldn't say we, Corey and Doug covered a lot. I listened intently. We are recording this, and we are going to post it on the website, so if you want to re-listen to it or you didn't catch something or you want to listen to something again, we are going to post it on there. You can get to the website from either one of our company names. The shorter one, the easier one to do on the phone is the Stronghold one, which is strwealth.com. That's S as in Sam, T as in Tom, R as in Robert, wealth.com. Both links go to the same site, so here in a few days we'll post that up for you so that if you wanted to hear something again, you'll be able to do so. And I would just like to take the opportunity to thank everybody for listening, and to Doug and Corey for taking time out of their day and helping educate our clients and prospective clients a little bit.
Well, we certainly appreciate the opportunity, and let us know if we can be of any help.
Outstanding. Thanks, guys. I appreciate it. Have a great day.
You too.